Hello, and welcome to this seminar on senior loans, brought to you by Four Lions. So there's three parts to the presentation. The first part, we're going to be looking at what senior loans are. Then we'll look at what are the advantages to investing in senior loans. And next we'll consider the investment options available. And finally, we'll look at what are the risks of investing in senior loans. Before we start, I must point out that this is an educational presentation. The material in this presentation should not be taken as investment advice, and do not use any of the materials as basis for any investment decisions. Thank you for listening. So what are senior loans? Senior loans are loans made to companies to support business growth, finance acquisitions, or even refinance existing debt. The loans cover a broad range of lending. At the higher end, in the institutional markets, these loans may be used in leveraged buyouts, whereas smaller companies may tap into debt markets to aid expansion. The loans are referred to as senior because of their position in the capital structure of the borrower. These loans have first priority in receiving interest payments, and in the event of bankruptcy, they are one of the first to be paid. In fact, these loans are usually secured against hard assets, such as plant and machinery, so even if the borrower can't pay the cash, the lenders can sell hard assets to recover some of the debt. However, whilst senior and secured, these loans are predominantly made to companies with below investment grade credit, so they are still risky. To compensate the investor for taking on this risk, the investors are paid a premium over normal interest rates. So let's have a look at why senior loans make an attractive investment. Regular bonds pay fixed income. This means that when interest rates rise, the fixed income element of the bond is no longer competitive compared to the higher interest rates offered elsewhere in the market. So the price of the bond drops to attract new investors. However, if you are already an investor, this drop in the bond's value creates an unrealized loss. Now the difference with senior loans is that they have floating interest rates which vary based on changes in market rates. Owning them is conceptually the equivalent of being a lender in a variable rate mortgage. They track the changes in interest rates, which means the income they produce is variable and not fixed like normal bonds. Senior loans are a growth-sensitive strategy. The strategy tends to perform well when the economy is growing. This is because during these periods, companies' demand for debt finance growth increases, and default rates are low because companies are generally performing well. Returns have historically been steady. This is, of course, with the exception of the credit crisis. There's certain segments of the senior loan market that have the potential to deliver comparable returns to stocks, but with a lower volatility. Senior loans have low correlations to other investment classes. They are a useful tool in providing diversification to a portfolio of stocks and bonds. So let's look at how to invest in senior loans. The guiding principle behind investing in senior loans should be ensuring the liquidity of the investment vehicle matches the liquidity of the underlying loan. Mutual funds represent one way to invest in senior loans. Whilst the most liquid segments of the senior loan market are available through open-end mutual funds, these funds usually maintain elevated levels of cash and also include regular high-yield bonds to offset the illiquidity of senior loans. Our preference would be closed-end mutual funds, which are not forced to sell the underlying loans when an investor redeems. Business development companies, or BDCs, offer another route to gaining exposure to senior loans. A BDC is a form of publicly traded private equity in the United States that lends to small, upcoming businesses. Like closed-end funds, the BDC is not forced to sell loans when an investor sells their shares. Hedge funds and private equity firms are another way to invest in senior loans. These vehicles are not publicly listed and hence are very illiquid. They tend to have high minimum investments and are generally only available to accredited investors. Now let's look at some of the risks attached to senior loans. Floating rate securities do tend to have higher credit risk than comparable fixed rate securities. In saying credit risk, what we mean is the risk that the borrower will not be able to pay back the principal and interest. Just because floating rate mitigates the interest rate risk, don't assume that the bonds are safe. While senior loans are used by companies operating along the spectrum of credit ratings, these bonds generally carry significant credit risk. When equity markets sell off, these bonds are not a safe haven. Generally, they sell off too. Senior loans are not generally liquid. They trade through a network of specialist dealers. In times of stress, there tend to be more sellers than buyers, and prices may plummet as a result. The prices generally recover in time, but the mark-to-market unrealized losses can be very large. Many of the companies that have senior loans in their capital structure are highly levered. For example, these are the favoured security in leveraged buyouts. Companies with significant debt burdens have a much higher risk of default in an economic downturn. As already explained, many of the companies that have senior loans are risky borrowers with high debt burdens. When the economy contracts, this strategy tends to underperform. Senior loans are closer to equity risk than high-quality bonds. Having the loan secured against an asset provides a false sense of security. Being able to sell an asset during boom times is easier than being forced to sell an asset during a recession. Think of a manufacturing company. A loan may be secured against one of its machines. If the economy went into recession and the company was forced into bankruptcy, one may assume that the loan may be recouped by seizing the machine and selling it to cover the amount of the loan outstanding. However, think about it, during a recession, most companies are not expanding, and so it may be difficult to find a buyer for the machine. The price may need to drop significantly in order to sell it. This reduction in price may not cover the loan obligations, and the lender may be left out of pocket. What are the take-home considerations we should remember when considering an investment in funds which operate in the senior loan marketplace? While the loans form a distinct sub-asset class, a kind of hybrid of high yield, whose returns may be uncorrelated to other asset classes. These uncorrelated returns can increase diversification in an investment portfolio. The loans can be risky and should not be assumed as a safe haven as some bonds are. The asset class is subject to cyclical tendencies and may well exhibit better return streams when an economy is growing. When an economy is in contraction, the asset class may evolve higher degrees of risk. Thank you for listening to this seminar. If you have any questions, please don't hesitate to give us a call on 415 332 1087. Alternatively, you can email us at info@4lions.com.